Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. The rapid expansion of AI infrastructure generally, and the global race to build data centers specifically, is raising concerns among industry leaders and investors about a potential bubble. Alibaba Group Chairman Zhou Cai has warned that the current pace of development could be outpacing demand, leading to excessive capital deployment in projects without clear commercial viability. At the HSBC Global Investment Summit in Hong Kong, Cai pointed out that billions are being spent by major technology companies and investment funds worldwide, but especially in North America, on AI-focused infrastructure, yet many projects are being built without secured clients. Quote, "I start to get worried when people are building data centers on spec," end quote, he cautioned, referring to speculative investments that could struggle to find buyers once operational. This skepticism comes amid an AI investment surge by firms such as Microsoft, Amazon, and Google, each committing tens of billions of dollars to expand data center capabilities. Alibaba itself has pledged over $52 billion towards AI in the next 3 years within mainland China. Meanwhile, the US government under the current administration, President Donald Trump, has been actively promoting AI investment with projects such as the proposed $500 billion Stargate initiative. However, trade policies, particularly tariffs on China and Mexico, threaten to inflate costs for US data centers reliant on imported hardware and semiconductors. The Stargate initiative is led by OpenAI, SoftBank, Oracle, and MGX, a UAE-backed investor. The companies have pledged an initial $100 billion, including pre-existing projects from the Biden era, with plans to expand over 4 years. The first Stargate data center, located in Texas, will be operated by Oracle to support OpenAI. Microsoft, Nvidia, and ARM Holdings have joined as technology partners. Japan-based SoftBank is expected to lead financing, with additional investors likely. US banking giant Goldman Sachs has estimated that companies, including American technology giants, will spend an estimated $1 trillion on AI in the coming years. That would include large outlays in data centers, chips, and the power grid. Adding to the uncertainty is the emergence of Chinese AI challenger DeepSeek, which recently unveiled an open-source model claimed to rival top US offerings but developed at a fraction of the cost. The breakthrough raises questions about whether the current level of investment in AI infrastructure is sustainable or necessary. Investors have started expressing doubts too, with Alibaba's stock dropping over 3% following Cai's remarks. Analysts at TD Cowen also highlighted Microsoft's recent cancellation of some US data center leases, fueling speculation that the market is overbuilding. Despite these concerns, however, the AI boom remains a significant driver of economic growth, with estimates suggesting it contributed up to 0.3% of US GDP in 2024. However, as demand fails to match expectations or geopolitical tensions further disrupt supply chains, the AI sector could face a painful correction akin to previous technology bubbles. But this new AI-driven economic growth isn't just coming from data centers. Nvidia is set to invest hundreds of billions of dollars in US-manufactured chips and electronics over the next 4 years, as the company adapts its supply chain to mitigate risks associated with President Donald Trump's tariff policies and to diversify production away from Asia. CEO Jensen Huang announced the spending shift in an interview with the UK-based Financial Times, expressing, quote, "Overall, we will procure, over the course of the next 4 years, probably $500 billion worth of electronics in total," end quote. Adding, quote, "And I think we can easily see ourselves manufacturing several hundred billion of it here in the United States," end quote. The move aligns with broader efforts by major technology companies such as Apple to reduce reliance on Asian supply chains, particularly Taiwan Semiconductor Manufacturing Company, TSMC. The Taiwan company recently announced a $100 billion investment in US-based chip manufacturing, supplementing previous commitments made under the Biden administration. Despite Nvidia's increasing US production capabilities, Huang acknowledged rising competition from China's Huawei, whose AI chips are rapidly advancing. Quote, "Huawei is the single most formidable technology company in China," end quote, he warned, adding that the company's presence in AI continues to expand. Meanwhile, while we're still in North America, US consumer confidence dropped sharply in March, reaching its lowest level in 4 years, as concerns over rising prices and economic instability intensified under the Trump administration's expanding tariff policies. The Conference Board's Consumer Confidence Index fell 7.2 points to 92.9, below economists' expectations of 94, while the measure of future expectations plunged nearly 10 points to 65.2, the lowest in 12 years. The decline reflects growing fears of inflation and economic slowdown. Surveys from the Conference Board and the University of Michigan indicate that consumers are increasingly wary of higher prices and the potential for stagflation. Inflation expectations for the coming year have risen to a 2-year high, coinciding with mounting concerns about job security and personal financial stability. Despite weak sentiment indicators, key economic data remains mixed. While unemployment remains low and manufacturing activity rebounded in February, persistent inflation, high borrowing costs, and labor market uncertainty continue to weigh on household finances. The Federal Reserve has maintained its benchmark interest rate steady, awaiting further clarity on Trump's economic policies. Economists now await Friday's inflation-adjusted consumer spending data to determine whether falling confidence will translate into reduced spending, a critical factor for future economic growth. Okay, next up we now move to Asia. Indonesia's currency has fallen to its lowest level against the US dollar since the 1998 Asian financial crisis, sparking concerns over the country's economic stability under the leadership of President Subianto. On yesterday, the currency briefly hit 16,640 per the US dollar, approaching its historic low of 16,800 seen during the fall of the former dictator Suharto. Bank Indonesia, the country's central bank, intervened in currency and bond markets to stabilize the currency, attributing its decline to global uncertainties, including US tariffs, a potential more hawkish Federal Reserve, and geopolitical tensions. However, investors are more focused on domestic concerns, particularly costly policies such as a $28 billion free lunch program, which has widened the country's budget deficit. Indonesia's economy is also showing signs of weakness, raising fears of interest rate cuts that could further pressure the currency. The currency has fallen nearly 3% against the dollar this year already, making it Asia's worst performing major currency. The Jakarta Stock Index has dropped 14% in dollar terms since the start of 2025, and there is another concern for investors too. This week, Indonesia named billionaire investor Ray Dalio and economist Jeffrey Sachs as advisors to its newly established sovereign wealth fund, Danatara, as the government seeks to bolster confidence in the fund's governance. The fund, expected to manage state assets worth approximately $900 billion, has faced mounting scrutiny from investors over transparency and political interference. Alongside Dalio and Sachs, former Capital Group portfolio manager Chapman Taylor and ex-Thai Prime Minister Thaksin Shinawatra were appointed as Danatara's advisory council. Former Indonesian presidents will also serve on the steering committee. The 4-week-old sovereign fund's chief operating officer, Doni Oskaria, emphasized that the selections followed a rigorous process aligned with President Subianto's directive to prioritize transparency. Subianto launched the Sovereign Wealth Fund in February as part of a sweeping consolidation of state-owned enterprises, SOEs, to spur economic growth through strategic investments in mineral processing, artificial intelligence, energy, and food industries. However, the direct control of the fund by the president and the diversion of state-owned enterprise dividends from the national budget to the fund have raised concerns over governance and fiscal stability. The move has unsettled investors, with Jakarta's benchmark stock index falling as much as 4.7% following the announcement. Indonesia's SOEs control assets exceeding $900 billion, with 4 of the largest publicly listed companies alone holding a market capitalization above $100 billion. Investors worry that consolidating these assets into a fund could reduce transparency and increase political interference. Within the administration, hopes are high for the new sovereign wealth fund. In an interview with Japanese financial media outlet Nikkei Asia, the chief investment officer said that it will seek to earn $8 billion a year, a 60% increase on the current level in dividends from state-owned enterprises. Meanwhile, concerns persist over how the government will fill the budgetary gap left by reduced SOE dividends. headwinds, particularly as the president advances costly social programs. I hope you're enjoying today's episode of Market Update. If you want to continue being on top of the most consequential, up-to-date financial and economic developments from around the world, maybe consider subscribing, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. This is also a big help. And finally, we move to Europe. US EV giant Tesla Inc. has faced a significant sales downturn in Europe, with registrations dropping for the 10th time in the past 12 months. According to the European Automobile Manufacturers Association, the company recorded 16,888 new vehicle registrations in February, marking a steep 40% decline year over year. In the first 2 months of 2025, Tesla's sales plummeted 43%, starkly contrasting with the broader industry's 31% increase in electric vehicle EV registrations. This downward trend comes at a critical juncture for Tesla, which recently began deliveries of its refreshed Model Y, the company's best-selling vehicle. The production transition, which necessitated factory shutdowns, including at its Berlin Gigafactory, led to lost or deferred sales. The delays, combined with CEO Elon Musk's firm move into politics, have compounded Tesla's struggles in the region. Musk's political influence has become a flashpoint, with his advisory role to US President Donald Trump and controversial statements such as advocating for the United States to withdraw from NATO has sparked backlash within Europe. Anti-Tesla sentiment has manifested in protests targeting the company's stores, charging stations, and even customer vehicles, particularly in Germany, where Musk's involvement in the country's federal elections drew scrutiny. The broader European auto market also showed signs of weakness, with overall new car sales dipping 3.1% in February amid economic uncertainty. Gasoline and diesel vehicle registrations fell 24% and 28% respectively as consumer confidence waned. Tesla's European rivals are seizing the opportunity to gain market share too. Tesla's sales performance in the coming months will provide a clearer picture of the impact of Musk's political moves and whether the new Model Y can reignite demand in Europe's challenging market landscape. Meanwhile, German software giant SAP has overtaken Danish pharmaceutical firm Novo Nordisk to become Europe's most valuable company, marking a significant milestone for Germany's stock market. SAP's market capitalization climbed to 313 billion euros on Monday, after its shares rose 1.4%, surpassing Novo Nordisk, whose stock declined by 1.3%. The shift reflects investor confidence in SAP's strategic transition to cloud services and artificial intelligence, though this does touch on our topic from the beginning of today's episode, a transformation that has driven a 40% surge in its stock price over the past year. The company's growth has also contributed to the strong performance of Frankfurt's DAX index, which has outperformed most major global markets. Conversely, Novo Nordisk has seen its valuation decline by nearly half since last summer, as concerns mount over its ability to sustain momentum beyond its blockbuster GLP-1 anti-obesity drugs like Ozempic. A second set of underwhelming trial results for its potential successor drug has further dampened investor sentiment. SAP's rise underscores the growing importance of Germany's technology sector. The company, founded in 1972 by former IBM engineers, has successfully transitioned from selling traditional software licenses to cloud-based services, a model that offers greater revenue predictability. Analysts project SAP's cloud revenue will grow by 29% in 2025, with total revenue expected to reach 38.5 billion euros, up 13% from last year. With the introduction of AI-powered data analytics tools and sustained cloud growth, SAP is poised to maintain its leadership in the European market. That is, unless, of course, there is a massive bubble in the space. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you all tomorrow.